Every one of our clients will own at least 5 investment properties.
And it's our mission to show you how. My name's Frank Ambezi.
And I'm Adrian Trimboli, and welcome to the Investing You podcast. It's finally happening. We're in the studio. Today we are talking about how to double the value of your property within 5 years, Mr. Frank. Welcome, my friend.
Good to be back.
Good to be back. Tell me, to the viewers or the listeners, as Frank said, can you double the value of your property within a 5-year period? Tell me that, sir.
Of course, it's been done. It's been done multiple times. I guess it relies on property fundamentals.
Yep.
And of course, the market cycle to be in the right cycle.
Okay.
Otherwise, if it's not in the right cycle and you get in there at the wrong time, you're not going to achieve, doubling your property portfolio in 5 years or less.
Okay. Awesome. Listeners, we're going to break it down today. I'm going to use Frank's brain. I'm going to interview him, and I'm going to essentially, for you guys, I'm going to break down exactly how you go about, or how Frank goes about finding a market, identifying a market, and then how he then determines, and obviously has a huge success rate of getting that property to double. So we're talking about a 500K property, 600K property.
Yeah.
Worth double, or around about that double mark, 100% growth within a 5-year period. Let's crack on. Tell me how you go about identifying what you just said.
So first, you need to understand where the market cycle is at, because if the market has already had, you've gotten in there too late, you can potentially, that market's already going to double in that period. But if you've gotten in there in year 3 or 4, then of course you've gone there at the wrong time. So there's a formula, but as well, it's not just buying in a market where it's a capital city and you're buying close to the city, and that's going to double in the space of 5 years just because it's close to all the amenities. It doesn't work like that. So there is a formula that is involved, and an understanding where that cycle is at. Okay. So I guess some of the key things that there is key things that you need to follow and address,
of course,
to make sure that market is going to be moving in that cycle. Now, normally our sweet spot we were buying at is around that 4 to 500K price point.
Yep.
Back in the day, if you go back 3 to 5 years ago, we're probably buying around that 300 grand price point. But of course, there are markets today that are starting that new growth phase, and the medium house price is $500,000 or $600,000, and they will move into that range in the next 5 years or so.
That $1 million range.
Yeah, correct.
Awesome. I love it. Thank you, Amelia, for getting me the notepad. I appreciate it. You mentioned getting into a market too late. Tell me that, or tell the listener that. What is considered too late? I know this kind of changes, but tell me.
So let's look at a current market that's doing quite well today. We look at Townsville.
Yep.
Townsville's a great market. Last year was the best performing market in Queensland.
Cool.
I think 27% growth had in the 12-month period. So if you look at that market and you say, okay, it's already had 27% growth in the last 12 months, and you go back the year before that was still double-digit growth. So over 10% growth in that time frame as well. So you've probably already had over 30 to 40%, maybe more growth since the last 2 years previously. So if you've already missed out on 40% or maybe even 50 or 60% during those times of the growth phase, then of course the market's still going to do well for probably another 2-3 years onwards.
Yep.
But then of course it's going to start slowing down. So if you bought a property today in Townsville, you probably can pick up a property for $500,000, maybe a little bit more, depending on what suburb and what you're looking for in particular. But then by then, in the next few years, that market's going to start slowing down because it's already had a lot of growth. If you got in there earlier, when we're buying property, we're buying duplexes for like 350 grand. We're buying houses for sub 300 and buying houses around the 350 market. So a lot of those clients have bought those properties today. Some of them already nearly doubled.
Yep.
So, that's a great way to, if the listener, you want to go and do a bit of research, just look at Townsville and look what it's done in the past. And you can see that's a way of indicating what the current market's doing.
Okay. So is there a percentage that you and the research team kind of go to and you're like, no, this market's moved. Like we've missed the cap here. I know it's kind of a hard question because obviously you identify the entire country, you're analysing the entire country. So you're never really late to a market because you're identifying it prior. But is there, for the listeners, something that they can kind of go off a percentage number, be like, we're too late here, or no?
Or really, I like to get in there really nice and early. So when we see in Townsville or Rockhampton or Bundaberg, these markets that we used to buy in, even, when we're buying in South Perth, there was no growth in the last 12 months. Like when I say growth, it was probably like single digit growth, like maybe 5 or 7%.
Yep.
So you weren't seeing that, 15, 20, 30% year on year growth.
Yep.
So really you want to get in there at the very beginning because, okay, so we all can't pick the bottom of the market.
Of course.
But we can pick near the bottom of that market where, hey, the market hasn't done quite well in the last, say, 4 or 5 years, but now they're starting to see a trend and things are starting to change. So how we identify that is by looking at property data, of course, and understanding where that data is lying and where it's trending.
Yep.
But before that as well, we need to look at as well what's going on the ground, bird's eye view, in the LGA of that area, what's happening on the ground to see, hey, what's this? There's a trend here, and that trend's going to follow in with property data trending, meaning that the data is going to show that there's more demand in the market, and that's when you can start to say, hey, in the future, this market's going to become a hotspot.
Yep, cool. So for the listeners, early, so if you're seeing double-digit growth, 15, 20% growth in the last year, it might be if it's done it for 1 year, you go, hey, okay. If it's done it for multiple years, you're missing out on 30, 40% growth. How much will the market swing in that 5 to 7 year period or in that growth phase?
Well, I want to say as well, what you need to address as well, if you're going to buy in those markets and there is no negotiation, what do I mean by that? You're buying in a market, you're talking to the agent, you want to, okay, let's negotiate on this property. The asking price is offers over 450. Awesome. Yep. You start negotiating with that agent. If he goes, hey, we've got multiple offers, there's 10 offers, 15 offers. Now, once again, you go do your DD and see if the agent's talking a bit of baloney, but the best way to test it is you put an offer in and you get blown out of the water and you don't win the property. Mm-hmm. You go again, you go for another property in the same area, you get blown away. And maybe you're putting the asking price is over 450, you're putting in 470, you're putting in 480, and you're not winning the properties. That there, you're starting to see that market get really, really hot in that area when there's no negotiation and you can't, you're not getting close to the asking price of what they're asking for, and it's going well over, then you're probably too late to that market. Okay.
And is that how, I know the answer to this, but again, for the viewer, is that how you guys determine in the sourcing team, it's time to get out of that market?
Correct.
Yeah. Cool.
Yeah.
Okay. Awesome. Cool. Okay. So I understand that. When to get into a market, when to get out of a market. I want to get a bit more of an understanding of the indicators of when to get into the market. You mentioned their bird's eye view. I want 5. I know you've got 70 or 100 or however many you've got. You've got 72. I know exactly how many you have. 5. Give the guys 5 indicators where it's like, this is where they can start. And maybe a little side piece here. Anyone is wanting the entire list of 72, if we could get that to them, Millie and the team, if we can get the 72 list to you guys. But the top 5 indicators that you look at right at the start.
So we're going to look at macroeconomics, so bird's eye view looking down. Now, we're not worrying about property. I'm not worrying about how many sales there are in a market. I'm not worried about, the vacancy rate just yet. I want to understand, number 1, infrastructure projects. What are the projects coming into the market, okay, and how are they going to influence the market? So I'm not looking at a town where it's just dominated by infrastructure projects, let's just say from a mining sector, okay, and it's like you go into a mining town, there's all this mining, infrastructure projects getting built into the area. I'm looking for a diversity as well. So mining, healthcare, retail trades, you're looking at, general infrastructure projects, you're looking at educational sector, renewable energy projects, tourism, planning. So with that there creates jobs, okay? But with the money getting spent there, you can see now the economy or the government and the local council are investing in that area and they're wanting to make a change. Cool. And with that's going to stir and influence the property market because 1, it will attract people, 2, it creates jobs, okay, which is my second part, which is job growth. With infrastructure projects going in, job growth will happen. So for example, like if we look at Bundaberg has a brand new hospital, $1 billion project.
$1
billion project.
$1 billion project.
It's the second hospital getting built in Bundaberg.
Right.
That there is going to create a lot of jobs. More nurses, more doctors, more receptionists, there's going to be security guards, there's going to be a whole bunch of things going on there. So with that's going to bring in more people, but of course we need a diversity of as well. So looking at other projects as well, getting built in. With job growth, that is one of the most important things of knowing if a market is going to perform. If jobs are going to increase, for example, Townsville had a massive job increase and it was one of the biggest increases in the country for job growth. If you look at Townsville, it was the number 1 performing region in Queensland last year. So job growth is super important. Okay.
I love it.
With that, your next step is number 3 is internal migration. Now, thing people look at is population growth, and you can't look at population growth because we look at the overseas migrants that came to Australia, back in the last 18 months, there was over 500,000 people that come to Australia. Majority of those people that came from overseas that migrated to Australia, where did they go to? Melbourne. Okay, so Melbourne's population has increased.
Okay.
But did Melbourne's property performance perform? No.
No.
It wasn't. It was the worst performing state. Okay, well, city and state as well. Victoria was. So, but if you look at internal migration, that is people leaving other parts around Australia who are Australian citizens and migrating to a new area. You look at Queensland, had the biggest internal migration pattern. Okay, in Queensland, of course, not in general. There's a lot of places that have done really well. Of course, some places haven't done well. But you look at once again, Townsville, you look at, Ipswich, you look at Logan, you look at, Gold Coast. Right. You look at those property markets there have done extremely well. That's because of internal migration. And people are moving there for a number of reasons, jobs, back to family, lifestyle. It can be a broad range. Okay, and with that, that's a very key indicator that you want to follow.
I love it.
Back on overseas migration, 70% of the overseas migrants that come to Australia, 70% of them can't afford to buy a family home for the first 5 years. So, yes, they will influence the market from a rental perspective. If you look at Melbourne, the rental market actually, the rents have increased a lot in the last, 12, 18 months. But from capital growth perspective, no. Okay. Number 4, what I look at is diversity in an economy. So I'm looking at what are the economic drivers that are driving that economy. So let's just touch on Geelong, for example. Geelong has about 7 industries that are greater than the state average. So what do I mean by that? So you're looking at what industries are driving the market. So is it healthcare, educational sector, retail trades, agriculture, mining, whatever it is. And you're looking at it and you're comparing it to the state average.
Yep.
I want 5 industries greater. Geelong has 7. Townsville, I think, has got about 8.
Love it.
If you look at Albury's got about 9. And I think Wagga Wagga is close to 9 as well. So with that, that's quite important because that's diversity. Okay. People get a bit, scared if regional towns go, oh, maybe growth might not be there because, it's not a city and there's not the population, but there's diversity there. Some regional towns have more diversity than cities. So that is quite important that you need to understand that, understanding the data. Okay.
Just on diversity, what does that actually mean for property prices? What does that actually mean for people in that area? Like, what does that mean if you could just break that down?
You can attract more people from different industries to come and invite them in that state or that region, I should say. So when you look at the jobs or infrastructure projects, and there's a diversity of projects and there's a creation of jobs, and the creation of jobs are diverse, internal migration will increase, but as well, you look at those other sectors, they will increase and perform as well and improve. So I look at past data as well when I look at economic drivers and look at what's it done in the past, and has it improved? And if certain sectors are improving and they were, you could say, weak sectors in that economy in the past, but now they're starting to improve and get close to the state average or go above, then there's investments going on from the state, federal, council area of improving those industries.
And 5 is your magic number.
5, and then the last one I would look at is GRP growth, so gross regional product growth.
Yep.
That's just understanding, is that economy there? For example, let's just any LGA, if it's Melton, Geelong, wherever it is that economy improving? Is it growing? Okay, and that's a great way to see if an economy is expanding, and you want it to expand, but you don't want it to contract. And if it's contracting, then you might be saying, oh, maybe the GRP growth is not there, and maybe there's not enough, investments going on. And if you're looking at this tiered structure, and you're seeing a positive effect on each sector or each step, GRP will follow that growth. If it doesn't follow that growth, that can be, you got to start looking into the data more of what's going on. So I know we've touched on 5, but that's where the due diligence will come into play.
Okay, awesome. And again, if anyone wants the other 67 points, we've got a document that we can send out to you guys. Just, I don't know how it's going to be. Maybe we can add it on. I don't know. It'll pop up maybe at this point. The 5 there, so that's value, guys. If you guys, that's a whole bunch of value on all of those parts. If all of these things stack up, where do you go next? Where do you go next from that point?
So macro economics, now you're looking at micro, now you're coming on the ground and you're looking at property and you're looking at data.
Okay.
So now we've got to make an informed decision. There's a bit to it, but let's start with the first one. So we want to look at inventory levels or sale listings.
Yep.
Okay. If we see inventory levels, which is how much supply is on the market. So let's just say if it's inventory is at a 2%, that means there's 2 months worth of stock left. And that means if there was no more stock, it will take 2 months to sell. Okay.
Yep.
And so normally you look at inventory 1 to 3 is kind of like in that range of a seller's market, you could say. 3 to 5 in between there is like a balanced market, and kind of like the time maybe you want to be looking at getting into that market. And then a 5 or a greater, you're looking at it as they call it a buyer's market, but as well you can be buying at the wrong time. So you need to really look at these data. So this next step with inventory level and the other steps I'm going to talk about, they kind of need to follow in the same direction to then identify if that market is going to have high demand as well.
Okay.
Because you might be looking at the macroeconomics and it looking really good on paper and everything's moving in the right direction. Fantastic. You move to then the microeconomics. You need to make sure as well if that is following in that same trend as well.
Okay.
And sometimes I would say you rather want to get in there early than be there too late.
Yep.
Okay.
Which we talked about this last night.
Yes,
actually.
correct.
So
So
rather get into a market too early. Too
Too early.
being what? No growth for like a Melbourne?
I would say too early is like you get there 6 months early, maybe even 12 months, depending on your strategy and format. Maybe 12 months is, pushing it, but around that, say, 6 to 12 month period.
Yep.
You don't want to be going in there 2 years or 3 years too early, okay? Because then you can't release that equity in 12 months' time to go again.
Yep.
So that's quite important. So inventory level, you want to see it trending down, okay? I normally look at it if it's around that 3 to 6 or 7%. I know it's a big broad range. Why am I saying that? It's because I want to see a trend in the previous month of it trending down, okay? If it's trending down, there's demand there. But next one is days on market. Days on market is showing how long the property will take to sell. If days on market isn't trending down, okay, and it's trending sideways, that's okay because it's a lagging indicator. It might be trending sideways. But if it starts to trend up, okay, and inventory is trending down, which it can do, then that can be that, yes, there's no real demand in that market, and properties are staying longer on the market, so days on market is trending up. So you need to have inventory levels and days on market trending in the same direction.
Gotcha.
A good broad range of days on market, if you're buying in a market where it's like 20 days or 15 days or 10 days or less on the market, that's quite hot. I probably would say 35 to 60 days in between there, depending on when you're getting into that market, is a great time as well, because then you're getting in there nice and early, but making sure that's trending down.
Yep.
So inventory level, you got days on market trending down, and then the next one's vacancy rates we look at, which is pretty basic, which is how many rentals on the market. The vacancy rate, you look at 3%. 3% is a market where it's probably not a great market to buy an investment property, because then more the tenants are going to be able to dictate where the rents are going, because there's that many properties on the market. 2 is like equilibrium, and then below 2 or below 1% is really in favor of the landlord, where rents, you can push up your rents and there's a high demand there. So if you see inventory trending down, you see days on market trending down, you see vacancy rates trending down, there's demand in that market from a capital growth perspective and a rental side of things.
I love it. You want to keep going. I can hear it in your breath there. You've had to take a breath. I want the viewers, if you just need to go over that again, there's a lot of numbers that you've just gone through, which is gold, right? Like that is gold. And that is the formula. I mean, there's obviously a whole bunch of other things, right? There's another literally 165 things left. But that is high level, all the way from the top of infrastructure projects, all the way down to vacancy rates, the 7 or 8 steps that you've just gone through, which I think is fucking awesome. And the time and the days and the, 35 days, 3% is equilibrium. That is perfect. I love that. I try to always ask a question from the viewer and what the viewer is potentially thinking. I think there'd be a lot of viewers thinking right now, what is so important about a property doubling in 5 years? Why can't you just go off the normal and double it in 10 years? Like, what's the actual... Who cares if I just go into a market and get 7%? What is the actual importance of going, no, I need to get 15, 20% for the first 5 years? What? Tell me about that.
So this means that you can get to your goal much quicker. Property is a long-term game. Mm-hmm. If your goal is to pay off your family home debt, okay, and you've got $500,000 or $1 million worth of debt, okay, the quicker you can pay that off, then the more you can relax and then start building wealth. If the goal is to build $100,000 passive income from your property portfolio, fantastic. the quicker you can get into those properties, that's going to allow you, because your properties have grown in value, you can take that equity, go again, buy another property or get into another asset, the quicker you can get to your goal. The longer it takes you to get there, the longer it's going to, the longer it means that you have to keep working, keep financing these properties, and, keep working towards building up that passive income goal.
Yep.
So I guess that's the point. But I guess if you use the right formula, you can never go wrong. So I think people go, yeah, but if you buy in, capital cities, you're going to achieve that, average growth rate over time, which is not the case as well, because every market works in different cycles. And if you look at Melbourne being one of the worst performing cities, it hasn't performed at all. You would want to put your money from 2020 to today. You would rather put your money in South Australia, Queensland, and WA, and that's just a fact. And you look at South Australia, you look at Brisbane, their property markets are more expensive than Melbourne today. Okay, and so that could have cost you millions of dollars opportunity cost if you just said, hey, I'm just going to invest in Melbourne because it's my own backyard and I live here and it's a capital city.
Yep.
It's the second best capital city at that point in time back in 2020, and you would have been the loser.
Okay, and that kind of derives from all those things that you've just mentioned, right? Like there would have been days on market going up, there would have been stock on market going up, the infrastructure, people leaving in drones.
And long term, you can't go wrong with property. Like
Yes.
if you hold a property in Melbourne, Perth, Toowoomba, Geelong for 30 years, they're all going to do well for 30 years.
Yes.
But do you want to take 30 years to get to your goal?
So, I mean, because that, again, the viewer, and that is the main thought, right? Like, over time, property across the country, it's going to average out 6 to 7%, right? So it is going to go well. Is there like a big difference over a 10-year period? Is there a difference in percentage growth there? Because I think that maybe has a big impact on how people think about this, right? Because you're right. Everyone thinks 30 years, 6%, happy days. Any difference around 10 years or 15 years? Like, is there a big difference between regions? Can a Melbourne, for example, over a 10-year period do 30%? Can a Bundaberg do 150%?
Yeah. So if you're looking at it from a 10-year perspective, yes, you can see that these other markets will swing a lot more and have more growth over 10 years. Yeah, like Townsville, if it's Townsville, Toowoomba, wherever it may be, some of these big regional towns, even some of the small capital cities like we've seen already, like with Perth and Brisbane and stuff like that. But yes, you will see that, especially if you can't have a market, I guess, especially like if your median house price is 1.5 million and in 5 years it's going to grow 150%. People aren't going to afford to buy that. But over a 10-year period, that market might move 15, 20, 30, maybe even 40, maybe even 60% over that 10-year period. So yes, I would say those other markets will perform much stronger and you have more ramp of growth because of the affordability and the opportunity there as well. And people all over Australia can afford that type of price point. So they will have more swings.
Yeah, I love it. Frank, I think we've given the listeners exactly what they came for. Just to recap, before we get into one final
I wanted to touch on
please, sir.
The macroeconomics. We missed out on a couple.
Go.
So
Shoot.
we went from inventory, days on market, and then vacancy rates.
Yes.
I won't get too technical, but you want to make sure as well that the rents, people can afford the rents in that market. So I'm always looking at mortgage repayments versus household income. If someone's income is more than 30% of someone's income is contributing to mortgage repayments, then you're going to get a thing called rent fatigue. Okay. Places like, example, you had a property in Fawkner.
Shithole.
You paid 600 grand for that property back in 2018, 2019. You sold it for nearly 800 grand. The rents were $450 for the whole time and didn't really increase.
Correct.
Now you look at the median house price was quite steep, nearly 800 grand for the sell that property. These houses that sell for probably $1 million. They're much nicer in that area. But you look at the rents, they couldn't really afford, and the rental growth wasn't very, very strong. And that's because nearly 30% or if not more, some of the income was contributing to the mortgage repayments.
Exactly.
So when I'm looking at a market, I'm looking at affordability as well. And that will change over time because the gentrification, wage increase, and in time will make that shift. But that's quite important to look at that as well because you don't...
30%.
You don't want more than 30% of someone's income contributing to mortgage repayments. Yeah. And you can get this data from ABS data or you can get a SQM data as well.
Cool. I love it. And I mean, it's pretty simple just to make that not as technical. Yeah. Like if you think about it, 30% of your income goes to rent You bump up rent by $50, that makes it 33%. All of a sudden, people need to live tighter. So you'd much rather that be at 15, 20%, means you can up the rent every single year. Again, compared to Bundaberg. Bundaberg, my property, in 4 years, I've raised the rent from $580 to $960. I've doubled the rent in 4 years. Oh, hit that. That's because of that, and that's because of that analysis there. So I love that. I'm tempted to keep going further because I know we can give more value here. Top 5 sites. You just said ABS data, but top 5 sites to find some of the stuff that you've just gone through.
So you got ABS data.
Yep.
That's great to get, your demographic data and industries and what's going on there.
Yep.
I'll look at ID profile.
Yep.
Okay, that's another great source of getting, macro economic data and population growth and forecasting, which is great also.
Yep.
The suburb finder,
Yep.
which is great, or suburb trends as well that we use. That's good also. CoreLogic and RP data, you get some really, really good data there as well. So SQM data as well. That, like if someone's looking for free data, that you'll be able to get free data from there also.
Amazing.
I do a lot of as well researching just online articles, reports, looking at state, federal, local council reports as well, and what's going on as well in there, because that will give you more insights of what's happening in the future and what's going on. Looking at property data is great. People can get really, really caught on the numbers. Numbers are important and where it's trending in the percentages, but as well you want to look at. You always, as an investor, you look in the future. How's this stock or this property or this cryptocurrency going to go up and why and what's going on? So you're always looking in the future and what's going on and how it's going to influence.
Yeah. So there's a now and then there's a future.
Yeah.
Awesome. Frank, I think you've done an excellent job here. I've sat back and saved my speaking, what's it called? Voice. What the f am I saying here? This will be blurred out. I've saved what am I trying to say here? I don't know what I'm trying to say. That's completely fine. What I've prepared for you, Frank, is a pretty cool one. Again, to just finish it up today, I think you've made it extremely visible for the viewer to realise that properties can double in 5 years. I want you to go through 5 regions. I've picked 5 regions. You don't know what they are yet, but that's okay. 5 regions, and I've actually also prepared something for you. Give me 1 second. I want you...
What you got here?
This is a smash or pass. So this is, to the viewer, this is pass, and that's a smash. Wait, sorry.
Second.
Smash, pass. Sorry, I'm looking at it from this end. This is smash, meaning we're giving it away. That's pass. I fucked that up again. That's smash, meaning we like it, and this is pass. Okay, so red means no, we don't like the asset. We wouldn't go and buy that property. That property is not going to be worth double in the next 4 to 5 years. I know you can't predict it, but at least the indicators. That one there means no good.
No good. Done. Leave
Okay.
it with me.
You got it? You can just flick it on mine. Yeah, I don't have to give you 2. That makes perfect sense. So what I want you to do, smash or pass, 1 minute on each. So this will be 5-minute exercise. And I want, again, for the viewer to see how your brain ticks and what your mind is thinking with an asset. And I want you to almost think like you're going in for a client.
Done.
Or for yourself.
Perfect.
Bunbury.
I'm going to go pass.
Ooh.
Reason why Bunbury's done really, really well. Okay, so if you look over the last 5 years, I've got a property in Bunbury. Paid $430 for my property. Today it's worth $680. Okay, it's already had a lot of growth. So you don't want to be buying in that market. So if I had a client, they go, I want to buy in Bunbury, I'm going to be like, you probably don't want to be buying in Bunbury. You've missed out on a lot of growth. So it's done phenomenal over the last 5 years. It's had a very, very strong influx of, population growth, internal migration as well. Projects have been, on fire. Mm-hmm. But it's a market you probably don't want to be investing anymore.
Because of that magic number, it's done multiple years of double digits.
Yeah, multiple years. We're buying a lot of property there as well in the 350, 380, some even cheaper than that. But that was when we were first getting in that market. It was very affordable. 350 grand to 380 grand for buying a house, 600 plus square meters. That's some of those clients have really doubled. And my house is verging to nearly get doubled as well.
Amazing. I love it. Next one. Thank you. Geelong.
I'm going to say smash.
Ooh, okay.
Now, Geelong is a market that it's had a very good rap over the last, you can say, 10 years or so. When the Ford factory closed down, they said that market was going to collapse, and it didn't. It hasn't performed that well over the last 5 years. It's been quite stagnant. It's, days on market have crept up and gone up and increased, but it has had a lot of projects and a lot of things going on. There is a lot of new estates and on the outer fringe suburbs that are being, there's a lot of development. So that can affect the supply, but if you buy in the right areas in the future, I think it's going to be a great area to invest.
Yep.
Is it going to perform in the next 12 months and get 12% or 20% growth? I think it's a little bit early, but I think in the next, say, 12 to 18 months, that's going to be a great market to look into and a place that's going to be very attractive. Internal migration is probably one of the biggest internal migration patterns in Victoria for there. So I do like Geelong.
I love it. Awesome. Townsville. You've mentioned it a few times.
Townsville, I love Townsville, but I'm going to say pass.
Yep.
Okay. It's a market, unfortunately, I never got a chance to secure one. It's one of my favorite property markets, I would say, because just of what's going on, the diversity of jobs, the diversity of infrastructure projects. Very strong economy. It's changed a lot over time. It did have a bit of a bad rap in the past because it did trend down back in the late 2000s. But it's a market that's done really, really well, and it's already had probably 50, 60% growth in the last few years. So it's a market you probably don't want to be buying in right now.
Properties will definitely double in that 5-year period.
The market's there's still growth there, still doing quite well. But yeah, once again, you don't want to be buying at the top of the market.
Yep. Cool. Awesome. Ballarat,
I'm going to say smash.
Cool.
Ballarat's a market that I do like. Once again, fundamentals, about 7 or 8 industries greater than the state average, very diverse economy. Population's pretty big as well, I think over 100,000 people roughly. And it's still quite early. It's quite similar to Geelong. It's not far from Geelong, Ballarat, but it's a market that in the future is going to be a very up and coming market, just because of the property fundamentals and the new projects that are going on. I think there's a big, massive hospital upgrade and a diversity of projects coming in as well, school upgrades and things like that also. And so you look at the data, days on market probably still quite high, but you're starting to see listing levels and inventory levels starting to come down, which is good signs as well. So Ballarat I do like. I guess we have the Victorian government who does make it hard for investors because of land tax issues. So Geelong and Ballarat fall in that category. So as an investor, being patient with, the next election, which I think will be next year, hopefully that does change and loosens up the laws. That will help fuel the property market. And I think as well with interest rates coming down, that will help as well with some of these areas because of the rental yields in Victoria are much lower compared to, say, Queensland or WA.
Yep. Okay. And you think that there's spots and properties in that market that will double? That's what you're saying?
Yeah, over the next coming years, yes.
Yeah,
yep.
Awesome. I love that. That's excellent. Wagga Wagga.
Wagga Wagga, I'm going to say pass, or smash, I should say. Smash. And it's a market is at the moment, it's done quite well in the past. Had about like 86% growth back in around that in the 5-year period mark from, I think it was like 2019 to 2023. Okay. It's a market's kind of gone trending sideways, but there is a lot of project and once again, diversity. I think it's got 9 industries greater than the state average, which is fantastic. But there is a lot of projects, a lot of opportunity. You got the Defence Force there as well. A lot of money getting spent on the Defence Force. That does attract a lot of people there for work and opportunity. And so I think with the market currently as it is, it's a market that, once again, I'm saying smash, but you probably don't want to be getting in there just yet. It's a market that is probably another 12 to 18 months away.
Okay.
That's looking very good for the future, I do believe, and will start to perform.
But still too early, a Geelong.
It's like a Geelong, yes. It's like a Geelong, but very strong economy. It's a pretty resilient market. It's not a market where you see prices start to trend down and go backwards. It's kind of, it holds its...
It's diverse.
Yeah, it holds its weight.
Awesome. I love it. To the viewer...
I might chuck in one or two in there if you want me to.
What?
Other places.
I was going to just say, you've spent probably 30 minutes with us. Frank's broken down the exact way that him and his research team go and find a market that's worth double. You've then gone through 3 regions that you would get into yourself. I think 5's enough. I think that if you get any more value, the camera will blow up. I don't think you can get that much more value in a 30-minute session. I think that was awesome. Really, really awesome. I think you're done, unless you've got anything else that you want to touch on. Don't touch on another market.
No, I won't touch on another market, but I think what I will say, there is good signs of, now there is starting to be a sentiment. There is starting to be a sentiment of change in the markets. where we're looking at different states and territories. So Queensland, your WA and South Australia have kind of walked away from.
Yep.
And now the tide is changing, and we're looking, it's Tassie, Victoria, and there's opportunity in New South Wales.
Yep.
So I think looking at what we've spoken about here today and looking at those data points, because there's a lot more things you do need to take in consideration, but there is a lot of opportunity coming, and the future does look bright, which is, I think with Victoria, with what it's gone through, a lot of people have left the the state.
Mm-hmm.
A lot of investors have sold out, but I think that tide is going to change as well. So just looking at this or listening to this today, I think go back, listen, do your research, have a look what's going on. Don't just scroll on realestate.com. That's not how you do research, but
100%.
understanding what we've spoken about today is actually going to help people make an informed decision.
Yep. And my suggestion, I'll put that into the camera. That's my page. It looks like a child's drawing, but that's okay. My suggestion would actually be to write down and actually have these things. If you are serious about doing the research, go to this level, because I'm writing this down because I'm also, I know a lot of these things, right? But it's still important for me to go back and actually understand these things. So if you haven't already, get a notebook out and actually write it. Frank, that was awesome. Next episode, I'm super excited for. It is going to be on the mindset principles. Now, we're very, very big on this. There's a reason why the second episode in person, we're touching on mindset. I don't want to talk about it now, but next episode, if you guys have enjoyed this, make sure you join us on the next one, because the next one, we broke it down. It started at 10 principles. We went down to 6 principles, and now we're going down to just 4 principles. We're going to share stories and insights of exactly how Frank and I have essentially used those principles, and they're like Bible, but also we're going to break down how it stopped our clients from building portfolios. This research stuff is awesome, right? If you haven't got those principles, those 4 principles that I'll touch on, you're toast. You literally will not get past property 2, property 3, property 4, or where Frank and I are at in our portfolio. So that's the next episode. Thank you. We're in person. Frank, that was awesome. And yeah, to the viewers, we'll see you next time.
See you next one, guys.
Thank you.